Oil prices drop amid Trump's tariff threats, U.S. crude stock build. Oil markets are in a state of flux, and it's all thanks to a perfect storm of geopolitical tensions and unexpected supply dynamics. But here's where it gets controversial. While President Trump's aggressive tariff threats aimed at Russia, and indirectly China, are meant to pressure an end to the Ukraine war, they're also sending oil prices on a roller coaster ride. So, what's really going on? Let's break it down in a way that even beginners can grasp. On Thursday, oil prices took a dip as investors grappled with the dual pressures of Trump's tariff threats and a surprising surge in U.S. crude oil inventories. Brent crude futures for September, expiring that same day, dropped by 61 cents, 0.83%, to $72.63 per barrel by 13:26 GMT. Similarly, U.S. West Texas, and this is the part most people miss, Trump's ultimatum to Russia, imposing 100% secondary tariffs on its trading partners if the Ukraine war isn't resolved within 10 to 12 days, has markets on edge. But it's not just Russia in the crosshairs. China, the largest buyer of Russian oil, has been warned of hefty tariffs if it continues its purchases. This raises a critical question. Could this strategy backfire by destabilizing global oil supplies further? Or is it a calculated move to force peace? We'd love to hear your thoughts in the comments. Adding to the complexity, U.S. crude oil inventories rose unexpectedly by 7.7 million barrels to 426.7 million barrels in the week ending July 25. This decline reflects strong demand during the driving season, a silver lining in an otherwise uncertain market. Harry Chilagirian of Onyx Capital Group summed it up well. The market front-runs the implications of President Trump's announcements before remembering that these policy intentions can turn on a dime if he can strike a deal. In other words, investors are reevaluating their positions until there's more clarity. But how long will this uncertainty last? And what does it mean for everyday consumers? Here's a thought-provoking question. Are Trump's tariffs a necessary evil to end the Ukraine war? Or are they a risky gamble that could disrupt global energy markets even further? Share your perspective below. Meanwhile, the U.S. Treasury Department's fresh sanctions on over 115 Iran-linked individuals, entities, and vessels, part of the Trump administration's maximum pressure campaign, add another layer of complexity. With so many moving parts, it's no wonder oil prices are fluctuating. As Fujitomi Securities analyst Toshitaka Tazawa noted, the surprise build in crude stocks and the larger-than-expected gasoline draw have created a neutral impact on the oil market for now. But how long will this balance last? As we navigate these turbulent times, one thing is clear. The intersection of politics and energy markets is more unpredictable than ever. Stay tuned. And let us know what you think. Is this the new normal or just a temporary storm? Oil prices surge 1% as Trump issues Russia ultimatum, threatens 100% tariffs on trading partners. Oil prices are surging as global markets grapple with the ripple effects of U.S. President Donald Trump's latest moves on Russia and trade policies. But here's where it gets controversial. The 1% jump in oil prices on Wednesday isn't just about supply shortages. It's a chess game between geopolitical tensions and economic signals. Let's break it down. Brent crude futures climbed 73 cents, or 1.01%, to $73.24 a barrel, while U.S. West Texas Intermediate WTI crude gained 79 cents, or 1.14%, settling at $70. These gains came despite mixed U.S. inventory data, which saw crude stocks rise by 7.7 million barrels, far above analysts' expectations of a 1.3 million barrel draw. Gasoline stocks fell by 2.7 million barrels, and distillate stockpiles, like diesel and heating oil, rose by 3.6 million barrels, defying predictions of a 0.3 million barrel increase. The real drama? Trump's tightened timeline. He's now threatening 100% secondary tariffs on countries trading Russian oil if Moscow doesn't comply within 10 to 12 days, a drastic shift from the earlier 50-day deadline. This includes a 25% tariff on Indian imports starting August 1st and unspecified penalties for purchasing Russian weapons. The U.S. has also warned China, Russia's top oil buyer, that it could face massive tariffs if it continues its purchases. And this is the part most people miss. India's potential compliance could slash 2.3 million barrels per day of Russian oil exports. As Dennis Kissler, a senior trading VP at BOK Financial notes, traders are viewing India's cooperation as a positive for crude prices. Meanwhile, JP Morgan analysts argue that while China is unlikely to heed U.S. sanctions, India's actions could reshape global oil flows. But let's not ignore the bigger picture. U.S. economic growth rebounded in Q2, but the numbers are misleading. The surge was largely driven by collapsing imports, not robust domestic demand, which grew at its slowest pace in over 2 years. The Federal Reserve is expected to hold interest rates steady this week, despite Trump's public pressure to cut borrowing costs. So what's next? Will these tariffs actually curb Russian oil exports, or will they just shift the market dynamics in unexpected ways? Share your thoughts in the comments. Do you think the U.S. strategy is a smart move? Or is it risking a backlash from key trading partners? Oil prices drop. Trump's tariff threats. U.S. stockpile surge explained. Imagine the delicate balance of global oil prices swaying like a pendulum, influenced by geopolitical tensions and unexpected inventory changes. This is precisely what happened recently, as oil prices experienced a dip amidst U.S. President Donald Trump's tariff threats and a surprising increase in U.S. crude oil stocks. Picture this, an oil pump jack steadily working outside Almatyevsk in the Republic of Tatarstan, Russia. This image encapsulates the heart of the oil industry, a sector that is constantly under the microscope of global economic shifts. The core issue: the market is in a state of anticipation, awaiting more clarity after Trump's tariff threats. The uncertainty is palpable, as investors weigh the potential supply risks stemming from Trump's push for a swift resolution to the war in Ukraine through additional tariffs. But here's where it gets controversial. Some analysts argue that Trump's policy intentions can change rapidly if a deal is struck, leading to a re-evaluation of the market until there is more clarity. The unexpected twist. Adding to the complexity, U.S. crude oil inventory saw an unexpected build, rising by 7.7 million barrels to 426.7 million barrels in the week ending July 25th. This increase was driven by lower exports, contrary to analysts' expectations of a draw of 1.3 million barrels. On the flip side, gasoline stocks, U.S. West Texas Intermediate crude for September fell 68 cents, or 0.97%, to $69.32. Both benchmarks lost ground on Thursday, after recording 1% gains on Wednesday. The expert opinion. The market front-runs the implications of President Trump's announcements before remembering that these policy intentions can turn on a dime if he can strike a deal, said Harry Chilagirian at Onyx Capital Group. We're seeing a re-evaluation until there is more clarity, he added. This sentiment echoes the cautious optimism and strategic waiting game that the market is currently playing. The bigger picture, U.S. inventory data showed a surprise build in crude stocks, but a bigger-than-expected gasoline draw supported the view of strong driving season demand, resulting in a neutral impact on the controversial question. But here's the part most people miss. How will these geopolitical tensions and inventory changes play out in the long run? Will Trump's tariff threats lead to a resolution in Ukraine, or will they further destabilize the market? And what about the unexpected build in U.S. crude stocks? Is this a one-time anomaly, or a sign of things to come? We want to hear from you. Share your thoughts in the comments below. Do you think Trump's tariff threats will stabilize or destabilize the oil market? How do you interpret the unexpected build in U.S. crude stocks? Let's discuss.